Effective this year, retirees are able to push back the age. They are forced to withdraw from their IRAs, 401ks, and other tax-deferred accounts. This is due to a new law that changed the age you must take your required minimum distributions and pushed it back from age 72 back to age 75 for some retirees. This leaves a lot of retirees to wonder whether this is the tax relief they were hoping for or whether this is just a hidden tax trap. We're going to find out in today's video. Now, for those that aren't familiar with required minimum distribution, otherwise known as RMDs, these are a forced withdrawal that you must take from your tax-deferred accounts. For a subset of retirees, this can be a massive tax issue. It forces them into higher brackets, causes them to owe more for Medicare. It can force your Social Security benefit into being fully taxed, along with a myriad of other issues. Now, previously, Congress mandated that retirees start these RMDs at age 72. But this was recently pushed back to age 73 for some retirees and age 75 for others. As you can see on the screen, this is determined by your birth year. Now, this shift leaves a lot of retirees to wonder just how big of an impact this will have. On the screen, you can see a forward-looking tax graph that is not uncommon for the clients that we work with. These clients saved a lot inside of their IRAs and 401ks while working and received a tax benefit for doing so. But now, once they enter retirement, they're left wondering if they really received a tax benefit after all. Notice that early in retirement, this retiree is in a great tax position. But once RMDs start in 2032, they are rapidly forced into higher brackets. A lot of that hard-earned wealth ends up being lost to taxes and other expenses. And so to remedy this, many retirees will benefit from implementing tax strategies like Roth conversions earlier in retirement, essentially spreading out their tax liability amongst additional years and then paying those taxes in lower tax brackets. But is this really needed anymore with the new RMD age? Pushing back forced distributions 3 years would seem to make a pretty big difference. And yes, it certainly impacts your tax strategy, but just by how much? Delaying RMDs 3 years, one would expect you would end up being forced to take less from your IRAs altogether. But frequently we see what I show on the screen. Delaying RMDs does avoid forced withdrawals, but it allows your tax-deferred accounts more time to grow. And this can lead to a bigger RMD because of a concept that we've talked about in the past called RMD creep. If you have more time for your tax-deferred accounts to grow, know that the RMD rate that you'll have to take on an ongoing basis also grows as you age, which means that you have two forces that are essentially growing that RMD. It's very common to see you end up taking more in RMDs once factoring in this growth, even with the delay. Now, I have an example on the screen showing simulated performance and showing this graph to 90, but keep in mind the crossover point here would happen at age 86. And so we see that even with delaying RMDs, this person would actually be forced to take more in total RMDs. Now, this is not to say this RMD age extension is bad just off this one data point. After all, $1 today is not equivalent to $1 5 years from now. And so a growing cost needs to be discounted, but this trend can be surprising to many. To discuss the real impact this will have for retirees, let's talk through 3 case studies. Through each of these case studies, I'll show the top 2 tax strategies, how much each of these tax strategies are expected to add in after-tax wealth, and then I'll show the difference between the old RMD age and the new RMD age. We'll first look at a single retiree who is 65 and has about $1 million in tax-deferred accounts. The blue strategy signifies maxing the 22% bracket through Roth conversions, while the green strategy signifies maxing the 24% bracket until 2026. That's when the Tax Cuts and Jobs Act expires. From there, the tax brackets will rise 2 to 4%. And so the retiree is going to drop down to maxing the 25% bracket, what has previously been the 22% bracket, after 2025. As a note of accuracy, the tax software we're going to use to analyze these 3 case studies is going to be one that we developed in-house, and to my knowledge is as accurate as you will get in terms of a forward-looking tax plan. It includes everything from how the tax brackets adjust over time, to adding in Medicare IRMAA expenses, to even factoring in the tax costs of passing to the next generation. Now, the first thing we'll notice from this first case study is the optimal strategy doesn't shift one bit from the RMD age just changing. Regardless of the old RMD age or the new one, the optimized strategy around the Tax Cuts and Jobs Act wins by a sizable margin. What we will notice, however, is the amount that you save or the amount that you add in after-tax wealth from these given tax strategies does decrease by about $35,000 in both examples. So the optimal strategy doesn't change, but the amount that you end up saving or adding to your after-tax wealth does shift slightly. Let's show another example. This time we'll use a married couple with a bit more in IRAs, but they're a few years younger. Interestingly enough, we see the same two optimal tax strategies, but now we just see the order flipped. So now maxing the 22% bracket is more optimal than optimizing around the Tax Cuts and Jobs Act. But once again, we see the same trend with the shift in RMD age. The optimal strategy does not change one bit, but the amount this couple would expect to save on taxes does change. Because of this, it will lower the benefit from the other tax strategies. And then as a final example, we're going to use a couple that has smaller IRA balances, but a much larger taxable account balance. We see a new tax strategy enter the mix with maxing out the 12% bracket. But the same trend continues. The optimal strategy doesn't change regardless of the change within the RMD age. But the amount of after-tax benefit you get from that optimized strategy does shift down slightly. And although I just picked 3 case studies to grab and illustrate in this video, know that we ran 100 case studies with balances varying from $500,000 in IRA balances all the way up to $6 million in IRA balances. And only in 9% of the cases did we see the optimal strategy end up shifting. In all cases, we saw the amount saved on taxes from that optimal strategy shift, but we didn't see the optimal strategy that you should take shift in a big way in the vast majority of cases. And so this RMD age shift will mean some slight tax savings for those retirees that don't really have a tax plan in retirement. But for those that are already optimizing for tax savings, you'll see very little shift in your optimal strategy. You should continue with the same tax strategy you did before in the vast majority of cases, on average, let's say. Now, despite seeing some tax savings from this RMD age shift, there are 2 areas I think certain retirees can fall into a trap. The first is for those retirees that are passing money on to the next generation, but only passing money on to a few heirs. In recent years, Congress changed the inheritance landscape. Now, if you pass on an IRA to the next generation, they're forced to withdraw that IRA within 10 years. Now, with some simple math, if your heir is designated to withdraw that full balance over 10 years, they're basically forced to withdraw 10% per year. Now, depending on when you pass away, the RMD rate that you'll be taking from your retirement assets will be far less than this. And so I can see an issue arise for certain retirees with this RMD age extension, because we'll see those tax deferred accounts grow that much larger, which means you pass on that much larger of a tax liability to the next generation. Then as they're forced to take that money out over an abbreviated time schedule, they will be forced to take that much larger of RMDs than if you stayed alive. Because of this, the delaying of RMDs only leads to much larger RMDs to the next generation. And then another big trap can come for those that are married but see the potential that one spouse passes away much sooner than the other spouse. In all of the case studies that I ran, this is the one scenario where we actually see the RMD age start to hurt in certain instances. And the reason for this, if you have one spouse that passes away early and you have that growing RMD because of RMDs extending out into the future, now you're just delaying those bigger RMDs for what's called the widow trap. At the death of one spouse, you go from the married filing jointly brackets and you now adjust down to the single filer brackets. You will now have half as much room in each tax bracket, half as much room in each IRMA bracket, but now typically just as large of RMDs. Because of this, tax costs can spike. I have this highlighted in red on the screen. And you see right when this widow trap starts, we see taxes rise by nearly 50% because of additional IRMA expenses, as well as spanning those tax brackets that much quicker. Now, this all being said, I do think the RMD age shift will be obviously beneficial to a certain subset of retirees, and that's also worth noting here as well. For those that aren't doing any tax planning, will certifiably save on taxes because of this shift. For those that weren't able to perform conversions earlier in retirement or weren't proactive enough, again, you will see a benefit from this age extension. If you're right on the border of 2 tax strategies, like maxing out the 12% bracket or maxing out the 22% bracket, this RMD age shift will likely shift those strategies where maxing out the 12% bracket is much closer, if not ahead. And so you'll be able to go with a much more conservative Roth conversion strategy. And then finally, if you believe you are likely to pass away earlier in retirement and you're either not passing to heirs at all or you're passing to a large number of heirs, again, you might see a tax benefit because you'll be subject to RMDs for a much smaller period of time. The point here being, in some ways, the RMD age extension is a critical one for a subset of retirees. It will certifiably lead to tax savings. For a huge swath of retirees, know that this RMD age shift doesn't change your tax strategy at all. The optimal strategy stays the same, and you should remain diligent in performing that tax strategy. In fact, I think it can be a tax trap for these retirees because it can lull you into thinking that tax planning isn't as important as it was before. Now, if you're wanting to learn more about this RMD age shift, as well as 2 other changes coming to RMDs, I highly recommend you click this video right here. As part of Secure Act 2.0, there were 3 big RMD changes that you need to know about for your retirement. Thanks for watching, and always remember, you don't need more money, you need a better plan.